Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, November 5th, 2024. It is 12:02 p.m. Eastern Time. I'm starting the video, so we're right at midday. Here's what I'm going to do, another kind of potpourri mix, various things that I'm watching, where the opportunities are. Will not be all-inclusive because all-inclusive with all the securities I've been covering lately, bonds, commodities, various commodities, stocks, various indexes, sectors, it'd be too long. So what we're going to do is I'm just kind of called it out here. Start out with a very brief update on the equity markets and a couple of the leading stocks there. That'll include Microsoft, Apple, NVDA, and then that kind of always reminds me of SMCI. That just hit my second and final target, so that one should be closed out, or at least tight stops at this point if you want to continue to let it ride. Time permitting, I want to get to gold, silver, GDX. Again, brief updates. I've covered them quite a bit lately. And then I want to work my way into those ag input stocks. I did get the charts out to you this morning on those and a link to the video that I did just over a month ago today. So you have that to reference if I really have to cut the video short for whatever reason. And then maybe just touch on the lithium sector again, the lithium stocks and ETF. Okay, it sounds like a lot, so let's dive into it. See how quick I can do this one. QQQ. This is a day that imagine nobody probably wants to short, but it's a good day to short in my opinion. Not super objective. I can't make a screaming case, but what I can do is tell you or reiterate again, if you've been following me, we had sell signals on the breakdowns below the uptrend lines off the August 5th lows on the two big large cap indexes that matter, the NASDAQ 100 and the S&P 500. Again, the Dow is only 30 stocks, not representative of the stock market or the economy. So these are the two I watch and tend to trade. And so that's it. So you break down, you hit support. We've been consolidating, and we're still below the downtrend line or the wedge. This is a 60-minute chart. Any move up to back test the wedge, there's a gap right there if they try to backfill the gap. But it is actually, I take it back a minute ago. I said it wasn't, kind of a pot shot. It is objective. This is that gap right there. I believe I even mentioned that the other day too. Stating after the breakdown, we had some support on the futures and QQQ. And so now it's a bounce back to that gap. So let me clarify or, kind of change what I said a second ago. This is an objective short entry, and it's sort of like buying the dip in an uptrend. When you are short selling, you do it opposite, everything in reverse. Now look, I mentioned yesterday it is election day today. You've got the economic count. You got the Fed on board this week. 2 p.m. Thursday instead of 2 p.m. tomorrow like they usually do because of the election. They kicked it back a day. So a lot that can and will most likely move the market. So still, nothing too crazy, but it is objective. Take it, leave it. It's up to you. But that's it. And then the next sell signal, and a pretty good one, will be a break below the recent lows because we have been consolidating following the breakdown, and that's also support there. So that's what it looks like on the 60-minute chart. This is my daily chart here. You can see it also holding, and I said I want to see the bottom of that purple zone. That's the market top range I gave you all the way back in late June, and so far that has it is at least, and I'm still going off that. That's the top where the rally off the October 2022 lows will end. We'll see. Only time will tell. And like any trade, it either works out or it doesn't. It's that simple, guys. There's the uptrend line off the lows, same low, August lows on SPY. A clear breakdown, still consolidating, trading below the well below the trend line. And this is a daily chart, also capping in my market top range. And as such, you see SPY also has right there. I'm going to pull this line up a little bit. Why did I do that? Because that's that gap I was talking about on QQQ. There's the big gap right there, and this is the bottom of the gap. I'm going to say this right now. The video's live. You're going to watch this in the beginning on a scale 1 to 10. This is close to a 10. It doesn't have to work out. One thing you can do is take a tight stop, but traders love these gaps, and I can just tell you this is a very objective short entry. You can have either a tight stop or a more liberal stop. There's a downtrend line off the highs. Now, your stop is going to be dependent on what your price target or targets are, if you even agree on the trade. So, I've given you long-term targets. The first one, which was already hit, and we covered there, and it's kind of a a flexible trade. Really, remember back then, my preference, strong preference, I made it very clear, was not to short SPY, but to short QQQ, and we did. We outperformed by about 60% on the downside, about a 16-17% drop in QQQ versus I think going from memory, about a 10-11% drop in SPY. So I still prefer QQQ, but I do expect, as I've mentioned in recent weeks, to see some of the SPY catch up on the next leg down based on the technical posture of other things that have since become more bearish looking, financials, healthcare, things that are weighted or included, I should say, even in SPY that are not in the NASDAQ 100. So if and when the banks break and healthcare and biotech and all that, you're going to see a bigger pull down on SPY. But you tend to get more bang for your buck trading QQQ if you're trading the stock market. My theory is simple. You're going to get paid. You're going to be right or wrong on your call on the market. You might as well get paid for it. It's just like trading gold versus trading GDX. If you're right on your call on gold, on the big calls, GDX is going to go up a multiplier of gold, at least 1.5, usually 2 times or more. And same thing on the downside if you're bearish. So you can tie up 100,000 in gold, or you can tie up 100,000 GDX and get paid a lot more. Same thing with SPY and QQQ. So either way, I just wanted to reiterate, and that's it. So bounce back. We're below the trend lines. The sell signals were already given. And then the other two big components of the NASDAQ 100 and S&P 500 are Microsoft and Apple. Remember, there's some of the big Mag 7, we want to call them Mag 8, whatever you want to call it, stocks that haven't broken down, but Microsoft is below that primary uptrend line right here, that blue uptrend line. We've had a series of trend lines, series of sell signals, and this is also kind of a tell for the market for me. I saw back in 2007 at the top of that bear market and in other markets, when the leaders stall out and start to underperform, that's typically a sign of a top. Now, it's glass half full, glass half empty kind of guy or gal, whichever you are. The glass half full folks will say, oh, well, it's okay because we're seeing rotation and broad participation now. That's, again, the glass half full look at it. But again, that's been the signature. Sometimes you do see the leaders take a breather and the rest of the market catch up. But again, the big tops have often been marked by that. So if you're glass half empty and you believe in the technicals line up to a much bigger move down in the coming year than we're going to see to the upside, then that's what you want to look at, these leaders. Now, if they all start taking back the breakdowns and you start seeing the FANGs or Mag 7, 8, whatever you want to call them, start powering to new highs, especially if they go on, they take out, it's not a whole lot before they take out the big divergence that's been building. Remember, this was a divergent high here. If it can make an equal or marginal new high, it'll be a divergent high. Much more than that, the divergence is gone. And then I don't have a strong case to make that this market is, that the big market leaders in the stock market is topped. So that's it. So Microsoft and Apple, again, I did an extensive video or videos in the last week or so covering all the Mag 8 or whatever you want to call them. Apple, also an official trade idea, hit the first target, and you can see what it's done since then. It was a sell, setup given before it broke this trend line with a sell signal to come on a break below the trend line. And this is just a trade playing out exactly as the technicals would indicate. Go to hit my first target, have a reaction. A reaction I define as when you're going down, it's either a bounce off a support level or a consolidation on that level or a combination thereof, and that's exactly what we've had. It's been 3 days trading on T1 with a little reflexive but kind of muted bounce so far today. This trade will look a lot better. I still maintain these targets, but obviously you need to now see T1, or at least the recent lows, those little spikes below, get taken out. And I also want to see the PPO make a bearish cross down below the zero line. You can see it. I have it right around negative 0.02, which is roughly the zero line. It delineates bullish and bearish trends. I'm talking about the PPO line, particularly the signal line, the white one. When it's above it, you're in a bull trend, and when you cross below and remain below, you're in a bear trend. Very simple stuff. So again, these aren't guaranteed things. They're just probability. Remember, I trade in probabilities, not possibilities, because anything's possible. And what's possible is also a potential bear flag continuation pattern. So if we can get this drop down here, that's going to take us down to at least a second target. maybe the third target down there, the 200-day moving averages, and that 207 price. But again, Apple's on a sell signal, and nowhere even close to, nor could it within the next day or two even negate that sell signal. By negating it, we have to go back above the trend line, a solid close back above there. So, and that hasn't happened. So I just wanted to reiterate why things may seem hunky-dory today. You know, 1+% rallying QQQ. Again, you're at gap resistance, and you have a couple of the big leaders broken down. And, you know, we start to get a little more downside, and we flip these indicators, and the other big Mag 8s that haven't broken down do break down. Then I have an even stronger case, and at that point, I would increase short positioning on the NASDAQ 100. So there's your update there, and another one, big one in there, has leapfrogged Apple now as the world's largest company, NVDA, but still a very bearish technical posture. I still have my long-term targets that are very much in play on NVIDIA, given to you back in late June, along with the long-term targets in Apple and QQQ. And this is it. We've just come back to where we started that drop. Remember, we hit T1, we covered reverse there. This is just a continuation of a long-term trade and how I expect it to play out, and so forth and so on. However, you've got to break. See, this is the trend line again. It's this magic one right here, which it hasn't broken yet off the, not magic, but very significant. The trend line's off the August 5th lows. That, to me, I cannot underemphasize or overemphasize, I'm sorry, the importance of those trend lines. And again, we've taken them out on QQQ and SPY, and that's the most important thing. The indexes themselves, and we've taken them out in a couple big leading stocks like Apple and Microsoft. Now we just need to see the rest of the lot, meaning the Mag 8, or at least the majority of those go, including and not limited to NVIDIA. So there it is, guys, sitting right there. The technicals tell me it's going to happen, most likely, but you know, you don't bet it too hard until it does. It's sometimes things look like they're going to happen and they don't happen, right? In life or in trading. So you wait for these to break, it's going to open the door. And on that, like I said, it's a little partner in crime. It was SMCI. First highlighted that as a short back here that day right there, then on that breakdown there, many times along the way, and including bounce backs to resistance, including this one here. I initially had one sole price target, but then I increased that to two, and a final target here, which has effectively been hit. You know my strategy. I always say cover above. I give you the actual support levels that I expect a reaction off of, but I always suggest and personally do cover slightly above the actual support level. T2, we came close enough right there. You can see we reversed a hair shy of, and again, 23, 27. So effectively, it's been hit. You can make a case. I'll tell you what, you can actually make a case to reverse it if you want. You'd want to have a stop somewhat below the bottom. It's closer to really as I had it as a single level. Oh yeah, it's a single level, but that's support down there. It's not a zone. T1 was a zone. 2163 is support. See, what I'm showing you here is it's now we finally have on the daily nice positive divergence in place. So SMCI is and looks like if this is correct, they're going to report. Are they reporting tonight, or did they already report? Let's see here. Oh yeah, after the bell. Okay, guys, so we'll play my game I like to play every time during earnings season. I'll call this one up. Why? Because it just hit my final target, or again close enough. Even if after hours it comes down in, as long as it hangs in this area. But you've got the positive divergence now. And anyway, I would look with earnings. You do you, but it's a great time before 4 p.m. today to cover that up, that position. Like I said, you can hedge up, but hedging is going to be expensive on this one. To buy, if you're short, to buy calls on it to protect your upside or protect your downside loss. To buy. Yeah, you'd buy calls to protect your downside if you're short. That's going to be expensive. So there's SMCI. One more I wanted to cover is SOXX. Of course, the semis themselves, kind of related. Big trend line. So again, we have major support on the semis. I've been covering this quite a bit lately, that potential head and shoulders. I covered this yesterday, so I won't spend too much time. We break the trend line, probably come down to the neckline on the Head and Shoulders pattern, and that'll probably go. So there it is. And if SMCI goes the other way, again, you take a stock in front of earnings. It's a big gamble, especially to establish a new position that you don't have big profits already embedded in. Worst case scenario, if you ride SMCI into earnings and you've got big double-digit gain, you're going to risk giving some of that back. Other things. Let's see. SMCI. UNG I just updated yesterday. It's a little pullback today, and again coming off that divergent low. So if you missed the breakout or the recovery back above 1262, well, you have an opportunity here on this pullback. You're still above support. You had the recent whipsaw, little brief move below, and still looks good. So anyways, there's an update on UNG, objective to add on or buy into on this pullback. The metals, gold, 60-minute chart. Let me go to the daily. It's a little more clear. You're still coming off that divergent high. You have this uptrend line 1 here, price support, and then the big yellow uptrend line. So there's big support here on gold. Remember, it's been building a big divergence. Divergence is not a sell signal. What are sell signals? Sell signals are breaks of support, such as the intersecting trend line in 247 support, and then the yellow uptrend line before, and that would bring it back down to there's a little minor support it might hiccup on right there around 234, but I think it'd bring us back to at least 229, possibly more. And then silver, right on the uptrend line, as it was a week or two ago. I pointed out last week there, pull back to the trend line, and the bounce has been very muted so far. Remember, coming off a big divergent high. This is SLV, the silver ETF, still holding that support right there. And same thing with GDX. So like I've been saying on this one, there's been a clear pattern of swing these little, it's like an upward EKG with these clear trend lines giving you the sell signals on the break of each uptrend line, including this most recent one, following the divergent highs that you got here. But sooner or later, this primary uptrend line is likely to break, and it just, from the technical posture, be careful. Look, you can game these bounces all day long, but you want to keep a relatively tight stop for if and when that goes. Again, we can get another hurrah. We can have 5 more hurrahs. There's no limit to how many hurrahs we can have, meaning rallies off the trend line. But typically, the divergence continues to build. It just shows waning momentum. And then sooner or later, you just have a flood of stop-loss orders that are hit. And you have a well-defined trend line, so traders are going to have them placed there. And I could go through the individual components. I'll rifle through them real quick. Newmont, as I highlighted the other day, probably the best looking because it's at big support, but already got the snot knocked out of it after it broke down. AEM just cracking there, but needs a break, 84.57. Gold, Barrick Gold, GOLD at support, 1884. I think that's a target I laid out to you recently, and that's been hit. But we're coming off a big divergent high. There could be more. So this one, WPM at support now. You can see the charts, the levels. FNV just hit that 130.91 support / first target. Deeper correction, which I think is possible, will bring us back to this uptrend line here. And if that's the case, there's going to be another 9% or so drop in that one. KGC walking the line right now like Johnny Cash, right on that uptrend line. Boom, 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 boom. Big divergence tells me sooner than later it's probably going to break. And there's your first and minimum target, 922, about an 8% drop. Secondary target's about a 17% drop to 831. So again, I've covered these in detail in recent videos, and a lot of them are right on, some crack in the line. So I just want to kind of keep updating the metals because I know some folks are long, some might be short, and some might be looking to go either way. And like I said, I would, at this point, I think it's picking up nickels in front of a steamroller to keep gaming the bounces off these levels at this point in time, based on the technical posture. And that one, I'm not narrating all these. Hopefully you can see the charts. I've covered all these in recent videos: breakdown, back test, secondary back test, rejection there. I won't go through them all, or we're going to do a super long video. So let me move on to the next stuff. Ag inputs. Okay, so I did get the charts out to you today. Really the big ones. Remember when I do these sector coverages or ETFs, or in this case it's not an ETF, I don't know of one. It's the sector itself. The sector is IX 1010 on TC 2000. Those are agricultural input stocks, companies that make things such as fertilizer and the likes. That's that level I gave you. Remember, I've done a lot of video. I've covered these stocks in and on and off, like just about every sector over the years. And, back here, you had a big divergent low. You had a breakout. You rallied to that level, got rejected. You rallied to the level again, got rejected. And here we are. We're right at it. So this is a very critical point. That's why I started to re-highlight these. I did that video for you a month ago. We're positive on most of them from that video. I highlighted them as objective add-ons there. Told you I had positions, just taken positions and all, and planned to add to if and when the charts started to firm up, which they've been doing. They've been firming up. The charts will firm up even more when this sector breaks out. That's a very nice, well-defined level. This, to me, is a big basing pattern right here. And boom, 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 boom. When these guys want to run, they can really run. They haven't started ripping by any means yet. A couple are taking off. Remember, so that was a divergent low. Rally got rejected off there. Put in another divergent low here recently. Broke out, and that's, I guess, I covered them in early October right there after that breakout. And so the sector has continued to firm up, but it will firm up a lot more again once we break out. And then at minimum, I see the sector, this is a sector as a whole, rallying up here about 10%. And that's, again, a minimum target. Looking at this chart and knowing the history of these stocks, they can do more than that. There's an uptrend line, which to buy pullbacks to, and or you can put tight stops below there, or you can use more liberal stuff. Nobody's trading the sector. Let me get away from that, because the sector, again, I may be wrong, to the best of my knowledge, doesn't have a direct play ETF on it. If you know of one, please do post it in the comment section below. CTVA, like I said, it had divergence, but I told you that it also has momentum. Divergence is always a sell signal, and this one had resistance there that I covered at the time, and it broke out, so that's bullish. Now, again, this one has negative divergence, so a break of that minor trend line is going to bring us back and maybe back test the breakout level right there, but that one you can see broke out of what's really a comparable resistance level to the sector itself that I just covered. And that's one of the bigger components. Remember, I'm doing these as I often do in order of market cap. And as again, if you didn't watch that video, you can click on the link in the post I gave you today. I italicized it, and it should be underlined, and it'll open the link to that post. You can watch that video. But what I said in there is, when you get down towards the end of the video, they're much, much smaller. Micro cap companies, small and even micro cap, tiny little companies, and even nano cap companies. And you can't put too much into those. They tend to rip and run when they really run, but they're also, companies that are very low priced, and especially in penny stockville, could just declare bankruptcy out of the blue. So do your own due diligence. I don't speak to the fundamentals on any of them. Just saying that typically, your large cap companies, mid cap even, and large cap companies have a lot lower risk than, and they have better liquidity as well than the smaller companies. Oh, and I meant to add it. I did in the comment section below that post, because one of the stocks went on to hit its first price target right after I got that post out to you today. That post went out in pre-market, so those are charts through yesterday's close. I'll get to that in a second. One of them hit price target, but a lot of these guys are coming up. They're reporting over the next week or so here, so keep that in mind, especially when taking new positions. My thoughts. Typically, if the charts are constructive, that's the way they go following earnings, but there are no guarantees, and make no mistake about it. I tend to be a contrarian trader. I catch tops and bottoms quite often, so let's make no mistake about it. These stocks are in a bear market. They're in a downtrend, so I'm bottom picking here, just like I top call and bottom fish all the time. It's not all my trades, but a lot of them. So keep that in mind, and in a downtrend, be careful. But with that being said, if I didn't like the sector, I wouldn't highlight them for you. Coming off a big divergent low, so you had the primary breakout here, back tested for a while, then you broke out the secondary trend line, and then boom, hit T1 yesterday. Again, they were highlighted back here in the early October, so it went down a little, but you can see a lot are hitting these uptrend lines and then reversing up, and those are the current targets. I might have updated in the charts I gave you today. I may have I covered them in the video, but I may have labeled them as such. Some of them were just marked but not labeled. And I might even have tweaked some of the lines. So go off the charts in that post. Or, well, now in this video, everything's updated here. CF, T1 was already hit. There was that level right there. Again, a lot of these stocks have just been dancing on. They had these peaks back here in 2023 and early 2024. Broke out, and I believe in that video I highlighted any pullback said this level is an objective long entry, and that's what happened. So you had an opportunity to exit there. Why might have you have exited? I know, look, I'm kind of positioned in these in longer term accounts, but because the majority haven't broken out or in the sector itself. So what I mean by that, what happens is, if you hit T1 and the majority of stocks haven't yet broken out, you can't make a super strong case, then you're going to likely get a pullback. If they all were breaking out and the sector broke out of that level I covered in the beginning of the video, then you have a better chance of very little, if any, reaction on T1, and then you might continue on up to T2. Again, when these stocks want to run, they can really run. I already covered that in the last video. Here was a rip right here of about, just in, what is that, 8 months. It went up about 162%. And again, you can see the levels. So we already popped that once, got sold into because it needs a sector to participate. And once it does, that should open the door to T2. It's a pretty, I don't believe, to me, it's not an aggressive target. And look, again, this either play out or not. Maybe these stocks continue to grind around in this range. Maybe they even fall out of the range. Who knows? I doubt it. You're always going to need fertilizers and, even in a recession and ag input materials. But Mosaic right there, beautiful breakout, back tested for about a week or so, rallied up, hit the 200. So that's also a common theme, guys. Keep in mind here, a lot of these, let's see, NTR. Yeah, NTR. Let me turn off all the lines. Watch the 200s. I highlighted that in the post I got out to you today. A lot of these stocks have been getting capped by the 200-day moving averages. That had it tried to break out, but the sector wasn't ready. So the rest of the lot weren't rallying it back at the time, the other stocks in the sector, and it got smacked down. That breakout above the 200s failed. So another test of the 200s. Knock, knock, knock. You eventually tap, tap, tap. You finally break out. That's what I think will likely happen soon. But it's something to watch for. So as I said today, watch those 200s. Price support comes in, resistance, I should say, at the same level, 51.80. So pretty much now, you can see we rallied all the way up, hit the 200 exponential. The simple's just below. So I'll pop over my first price target, should open the door to the next one. And at that point, you'll probably see the momentum traders come in and rip this one up to T4 pretty quickly. And so from where we're at today, again, you want to, it's kind of a random move right now. You're in no man's land. First support here is about 49 and then the trend line below. But just to measure it out, to give you an idea, if T4 is hit, that's going to be about a 20% gain. CF, already didn't, yeah, I covered that. Yep, hit that level, pulled back. I was just showing you, that's why I went backwards. I was showing you the 200-day moving averages. There's Mosaic, and turn off all the lines, and you can see a perfect tag right there, the 200-day. The blue line is a simple, but they come in together. The exponential's just above it in red. Look at that, perfect tag of the simple, but it hit the exponential there. And this is what I've talked about many times. That's why you see two 200-day moving averages on my chart. I don't follow any other traders. I do my own thing in my own world, but I don't think many put them both up there. And I always say some traders use a 200 simple, some use a 200-day exponential. Hence, I use both because some traders are going to sell that one and some will trade that. So I like to see them in a downtrend both taken out. And if you're gaming rallies, or looking to short on rallies back, you might want to short the first of the two that are hit because that's often the one that'll do the trick. But you can see again in a bull trend, they trade above, and traders love to buy pullbacks to the 200-day moving averages, right? And then it was kind of volatile there. But once they were clearly gone here, every rally back to the 200 was rejected. And so, Randy, why aren't you shorting them here? Well, the reason I'm not shorting them because I made the bullish case a month ago to go long, and they're breaking out, and I'm now waiting for a break above those 200s and then to increase those positions. FMC, just a same thing since I covered it back a month ago. Massive, very well clear resistance there. It's 67.90. Uptrend line gives you an ascending triangle pattern. It's trying to get through the 200s, but it's banging on price resistance as well. Pop, pop, pop. There's your first three targets. And, depending on what happens, especially if the stock market can hold up after this week with the Fed and the elections and foil the recent sell signals, then I might add additional targets on these and or the ag commodities. Remember, I started that video covering the agricultural commodities because it's my experience when they rally, wheat, corn, soybeans, things like that. That's when you tend to see the ag input stocks also rally. ICL, just a beautiful, gonna give you that downtrend line, popped, hit the first target, and the 200-day moving averages. So see, you get my the levels I'm watching now is made pretty clear, right? 200-day moving averages, take those out. You've most likely begun a new uptrend, and then again, that's a reason I may add additional targets. But even then, even if I don't, from the breakout point, if T4 is hit, that's going to be a return of about 57%. Good enough to, beat the market's return over the next 10 years, in my opinion. SMG, Scott's Miracle-Gro, uptrend line if we get a pullback. Not one of my favorites. I think I probably said that in the other video, but covered it. UAN, divergent low there. Another divergent low recently. Needs to pop 70, 470, and then it'll run. These are your targets right there. LVRO, I'm getting down to smaller companies now. There's your uptrend line. Another failed. Remember, this is just an intraday pop. That's why I often speak of when I say a breakout above a solid break and or daily close. There's another example. See that? You zoom in tight. Those are called wicks. When you see the skinny part, the shadow of the candle is above there. That means you went there intraday and then only to get close a day back on there. So if you wait for a solid breakout or a daily close above the level, it's more likely to stick. And so that was, I wouldn't even call it a failed breakout. At least if you're trading on the daily time frame, because you wait for the daily close. Now, you can take those. Sometimes they do stick. Either way, I just wanted to point that out. That's what you need to see on this one. BIOX is just, there'll be a short squeeze in here soon. If the sector goes, it'll explode, I'm sure. Just be careful. There's something going on here. It broke this support and it hasn't looked back. It's been waterfall selling, but a short squeeze or just whatever reason, this thing could rip. And so this is more of a what I call gunslinger trade in the sector. Higher risk but higher return potential, and this thing could go up. If it hits that target right there, I gave you 969, a little south of that, and the intersecting downtrend line, the 200-day moving averages, you're looking at a trade you can make about 50% on your money in probably short order. IPI, that's the one I added in the comment section after that post I got you today. Yesterday, it closed right here and broke out above this downtrend line. And you can see a lot of these guys are walking up this uptrend line. They're comparable uptrend lines. And this one, like I've had here forever and a day, resistance zone. This to me, I know it's a busy chart. I'm going to highlight every, right here was support. Come across here, it was resistance. Come across here, it was resistance, 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 but broken out. If it can hold and get above here, in other words, if it can hit T2, especially on a closing basis, print a solid close above there, that should open the door to these next targets. And again, if you want to buy pullbacks to the levels. If you want to know where to stop out, not too far below that, this lowest uptrend line right here would be an objective stop. AVD, divergence, kind of messy looking chart. Again, birds of a feather, guys. If they start running, some of the big ones take off first, and they'll if the sector gets a sustained rally, then the bottom pickers come in, start picking up these little lower priced, higher risk stocks. CGA still needs to take out the downtrend line. Seed needs to take out the downtrend line, but it's also pulled back to the uptrend line right here. So you can make a case to go long there, and then additional long entry on a break above the. That's not it. And just moved one of my price targets. I don't know where that was. I'll have to fix that. Let's just put it right there. This trend line right here. needs to pop that and run. Y10 went away. I don't know what happened there. And ITO, again, you're getting down to the little penny stock fill, and that's it. All right, guys. Final one, the lithium stocks I highlighted a couple weeks back. A week or two ago, somebody asked me about uranium. I said, look, I kind of like the lithium stocks better. I know that's not uranium and lithium have nothing to do with each other, but I checked, URA was kind of in an uptrend, but just looking, I didn't see as much RR, risk reward, the RR ratio, the risk to return profile wasn't as nice. LIT is a lithium ETF. I highlighted this breakout here, and then the pullback to right here. 41.47 is objective entry, and it's working its way up. Ultimately, it needs to take out this downtrend line to even open a door, to that maximum target I have right now, about 57.90. And it would help if it can get a sustained breakout above 46.54, because that seemed to be with support here, then resistance. We had a one-day wonder after this breakout. The momentum took us up, so pop above there should take us up to those next targets. And then there's individual ones in there. I did this in a video recently, so you can look that up. I'm just going to rifle through them in no particular order. LIT is ETF. A lot of these companies are not U.S. based, so when you go with the ETF, they can have the exposure to invest in some of those international companies that you can't invest in. You might not be able to, depending on who your broker is. But constructive charts. There's a downtrend line breakout back test. These little choppy looking candles are because these are thinly traded companies. These are, low volume, overseas companies. But that one breakout back test, and that's constructive. This one's working its way up that uptrend line. ALB coming off that divergent low. Needs to take out 108.79. It's the first target, first resistance, and then the trend line there, and then about one. I'm going to pull that up a little higher, about 152. All right, I'm going to stop it here. SQM ready to pop. If it pops that downtrend line, it's also going to pop the 200-day moving averages. You can see them right overlapping the downtrend line. So here's one again, in an uptrend, buy the 200s, buy the 200s. When the 200s break, row, get out of Dodge. Start then shorting rallies back into the 200s. But then when the charts get constructive, stop doing that, because it's not going to last forever. There's going to be another trend change. A lot of these stocks, this is swing trading, guys. This is the difference of investing. Investors put their money in this stock back here. This is as far back as I can roll in 2019, and they lose 64% because they're bullish on this stock. Then from there, they're up now 156%, and then recently they're down 28% again from where they started, and they go nowhere, even though they've been bullish on the on this sector. But swing traders, that's what we try to attempt to do. In trend traders, try to game as much. Not all. We sometimes we catch every penny of a move, but anyways, this is what I want to show you. We're setting up for the potentially next leg up. Okay, and that's it. Again, far from all inclusive, but just some of the things I'm highlighting potential places to make money. And again, I just wanted to reiterate, don't read too much in today's move, just as if tomorrow we're down, 2%. Watch the key levels on the indexes and the key stocks. And then, like I said, Thursday after the Fed, there's the post-Fed noise, meaning at 2 p.m. they make their rate decision. Then you have Powell's dog and pony show at 2:30 with the media. That goes till market will swing up and down to probably about 3 o'clock-ish. And then even then, that's not always the direction the market picks. So, and then we'll also start to see the election results coming in by then. So, like I said, if you are risk adverse, I can think of no better week to shut the computer off and go do whatever you do, or just watch, sit back. But also, have your trading plan from you, whatever it is, whether it's the stock market, whether it's individual sectors, stocks, precious metals, and be ready to move if once all that stuff's out of the way this week. We're either going to have market will probably either rally on up, maybe try to test the old highs in the NASDAQ 100, or I think crap out is what the charts look like, especially if we can get just a couple more of those market leading Mag 8 or whatever you want to call them stocks breaking down. All right, we're going to leave it here, wrap it up. This has been Randy Finney with Right Side of the Chart. Have a great day.